All right, let's dive right into this explainer and demystify the dense Q2 2026 financial report from one of Northern New England's absolute banking powerhouses. Look, if you follow the regional banking sector, you already know that navigating our current economic climate requires a tricky balancing act. You need a defensive fortress of a balance sheet, but you also need an offensive growth strategy. Today, we're unpacking exactly how one institution is managing to pull off both, and honestly, they're doing it remarkably well. So, you gotta ask yourself, when a major regional bank comes out and claims a record-breaking quarter, what does that actually look like on paper? In an industry where margins are constantly being squeezed and every penny of deposit cost is intensely scrutinized, hitting a record is absolutely no small feat. It literally requires the whole operation to fire on all cylinders at the exact same time. We're talking about Camden National Corporation. This is a financial engine with 72 banking centers deeply rooted across Maine and New Hampshire. With a history stretching all the way back to 1875, they aren't just a bank, they're a vital economic pillar in their region, holding $7 billion in total assets. That size gives them the muscle to compete aggressively while still maintaining the community-focused agility that megabanks usually lack. Here is your bottom line up front. A blockbuster record quarterly net income of $23 million. That impressive figure translates to a diluted earnings per share of $1.35. And to put that into perspective, in a quarter where so many of their peers are just struggling to maintain flat growth, Camden National is posting a 5% increase in net income from just the first quarter of this year alone. So, how did they pull it off? In this explainer, we're going to act like financial mechanics. We'll break it down into 4 parts: their record-breaking Q2 results, the revenue streams, the balance sheet foundation, and finally, how all of this delivers value to the shareholders. Starting right off with Section 1, record-breaking Q2 results. Let's look at the momentum driving these numbers. You know, a single good quarter can sometimes just be a fluke, maybe driven by a one-off accounting event. But CEO Simon Griffiths connects this raw data directly to their deliberate investments in talent and deep customer relationships. He specifically highlights that this wasn't accidental. They've been incredibly disciplined in their execution, delivering 3% annualized loan growth this quarter, which really proves that their relationship-first community banking model is highly effective at generating real momentum. And you can see this long-term strategy paying off year over year. Thanks to robust core business growth and the super successful integration of Northway Financial, which they acquired back on January 1st, 2025, their year-to-date net income has literally more than doubled. We're looking at a massive leap from $21.4 million in the first half of 2025 to a staggering $44.9 million for the first 6 months of 2026. That is just transformational growth. Moving right along to Section 2, revenue, where we'll look at interest and beyond. Now, defending your net interest margin, or NIM, is pretty much the ultimate test for a bank's treasury team in today's volatile rate environment. So, how did Camden's core lending engine actually perform? Well, get this. Camden's net interest margin actually expanded by 2 basis points on a linked quarter basis, hitting 3.26%. I know, 2 basis points might sound tiny, but in a market where practically everyone else is experiencing margin compression, any expansion is a huge divergence from industry trends. They pulled this off primarily by successfully lowering their funding costs, basically optimizing their mix away from more expensive brokered deposits while keeping their core deposits totally stable. But they definitely aren't just relying on interest. While total revenue grew a very healthy 5% quarter over quarter, their non-interest income experienced a massive 21% jump from just the first quarter, reaching $14.5 million. And honestly, this kind of diversification is exactly what you want to see to protect a bank from pure interest rate risk. So where did that 21% leap come from? It wasn't just a lucky break in one department. It was fueled by broad success across all their complementary lines. We're seeing strong increases in deposit customer revenue and debit card income. But the real star of the show here is their wealth and brokerage business. They now boast an impressive $2.6 billion in assets under administration. That's a 13% increase over the same period last year, bringing in reliable fee-based revenue that beautifully balances out their lending operations. Let's transition over to Section 3, the balance sheet foundation, the glue holding all this together. Revenue is great, for sure, but we really need to look at operational health and efficiency to see if they're actually capturing that value. because if a bank is bleeding cash on operations or taking on bad loans, those top-line profits will vanish in a heartbeat. Impressively, they kept their GAAP efficiency ratio super tight at 55.42%. Just for context, anything in the mid-50s for a regional bank is exceptional. And what makes this even more of a flex is that they maintain this efficiency while absorbing typical, heavy second-quarter expenses. We're talking about things like annual salary increases, equity awards for directors, and the tab for top-performing sales team recognition events. They absorbed all of that overhead and still ran an incredibly tight ship. Let's see how this translates to their $5 billion loan portfolio. The portfolio is highly diversified. The biggest chunks are commercial real estate at $2.19 billion and residential real estate at roughly $2 billion. But notice the strategic optimization that happened this specific quarter. They drove a very targeted 7% jump in home equity loans and a 4% growth in commercial loans. Basically, they're lending exactly where the yields make the most sense. Now, here is a fascinating forward-looking indicator for you. While the actual funded loans sitting on the balance sheet grew by a steady, disciplined 1% during the quarter, the committed pipeline, meaning the loans that have been approved and are just waiting to be funded, skyrocketed by 45%. That pipeline now sits at $185.7 million. This shows immense future demand and sets them up beautifully for continued growth in the second half of the year. And if you're wondering about risk, which, let's be real, you absolutely should be whenever a bank is growing its loan pipeline that fast, the asset quality metrics here are phenomenal. Their annualized net charge-offs are practically non-existent at just 0.04%. Non-performing loans make up a tiny 0.24% of the total portfolio. And just to be extra safe, their allowance for credit losses covers those non-performing loans by nearly 4 times. So yes, they're growing, but they're doing it with pristine underwriting standards. Which brings us to our final part, Section 4. Delivering shareholder value. What does this highly efficient engine mean for the folks actually holding the stock? It translates directly into hard, tangible rewards. The intrinsic book value of the company increased nicely to $42.96 per share. Management also took advantage of their strong capital position to aggressively repurchase 52,000 shares of common stock at a weighted average price of $47.64. Plus, on top of all that, they declared a cash dividend of 0.42 cents per share, which delivers a highly respectable 3.10% annualized dividend yield based on quarter-end pricing. They are returning capital to shareholders from a position of profound strength. So, I'll leave you with this. The data really suggests this banking engine is just getting warmed up. But the real question is, if they can deliver these kinds of metrics in a volatile environment, what happens when macro conditions actually turn in their favor? How will highly optimized regional powerhouses like Camden National continue to outpace expectations for the rest of 2026? Thanks for joining me for this explainer, and I highly encourage you to dig deeper into these numbers yourself. They tell a truly fascinating story of strategic discipline.